Investments, volatility, return, loss, those are all headlines that dominate our frontal lobar cortex of our brain when the investment returns are going sideways and or down. And it oftentimes leads us to believe with recency bias that the number one wealth eroder is actually investment loss or sometimes the cost of the investment. Unfortunately, we're forgetting one key factor of that equation, that is Uncle Sam himself. Find out why in this segment, why Uncle Sam is actually one of the largest wealth eroders that we have in our system today. Welcome back to Consider This Program. I'm your host, Grant Soliven.
And I'm Jamie Burton.
And Jamie, we get the pleasure of talking about Uncle Sam in this segment.
Yes, we do.
The big man himself. I do love his shirt, and I love those striped pants. But when it comes to your financial situation, Uncle Sam, unfortunately, does have the upper hand. Now, we've often talked about in the show, and you've heard us kind of allude to it, there's two tax codes. Oftentimes it's believed that it's for the rich and for the poor, but realistically it's for the informed and for the uninformed. And unfortunately, they don't teach us tax code in school, so many of us are uninformed. So, Jamie, I want to go through today why Uncle Sam is actually one of the largest wealth eroders that you have in the system today, and what are some things we can do about it to build property tax diversification in an ever-changing tax environment. Mm-hmm. So, tax planning. There's tax planning and there's tax preparation, two very different things. And Jamie, when we talk about tax planning and tax preparation, what are they? Why are they different? Why are they both critical?
Mm-hmm. So tax planning is the planning that you do before December 31st of the year that you're in. So this is the decisions. Do I need to make Roth conversions? Do I need to do planning for my business? There are really important tax decisions that need to be made before the end of the year. If you don't make them, you lose your opportunity. The tax reporting is after that December 31st deadline. You no longer have that opportunity to do the tax planning, and you get all of your stuff to your accountant and you say, okay, here's what I did for the previous year. Prepare my taxes and tell me how much I have to send to Uncle Sam.
100%. And here's something, don't forget in the last segment, Jamie did a beautiful job talking about the tax planning portion of what we do and why it's so important. Don't hear me villainize CPAs or tax preparers. They're wonderful people. I use one. We trust them. We work with many good ones. But when you take a look what a CPA's responsibility is, it's their job to ensure that you're paying as little tax today as humanly possible, right? And for the ultra good ones that we work with, they also understand that you also have to pay taxes in the future, and things can change. And so when we're talking about tax planning, we're also talking about how do we effectively stretch out and maximize your tax leverage, not just today, but also in the future. Because what Jamie just said is right. Once December 31st, once that clock strikes midnight and we're in Jan 1, all the planning opportunities that we had access to are gone. And we have to then restart for the next year. So when you're doing your preparing, don't forget that document should not just go in a dusty drawer and sit there to die and get eaten up by moths. It is a very powerful document you can use to leverage what you're going to do for tax planning in the coming year, especially because the tax code, as Jamie said earlier, is going to sunset December 31st, 2025, if not sooner, by Congress's action. So we have very limited time to make very, very deep course corrective action on our plan, and tax planning is a huge part of that. It's so important. And one of the biggest tax planning elements that we actually address, we call it the V for Victory. It was something that Joe, our managing partner, created. And it's how we use and leverage Social Security versus the deferred assets Jamie brought up earlier in the conversation in our last segment. So Jamie, do me a favor. Help us understand, what is the Retirement V for Victory? What does it do? And what are some of the elements inside of it that we have to pay close attention to and manage appropriately?
Sure. So it's always so funny when you have meetings with our families, because it's really clear who we have been taking care of for a long time and who is kind of newer to the company and is still trying to learn how we prioritize things and how we go about things. Because a lot of times when you first come in, taxes are the last thing that you want to talk about. Nobody wants to talk about taxes. When you come in, you want to talk about investment returns. What's my money doing? What return did I get? And that's typically the most important thing. But what we have to do is rein back that conversation. Like, yes, you got a good return on your investments, but that is not what's most important right now. What's most important for you in your future is to make sure that we look at these taxes and look at the tax brackets that you're in, the tax buckets that you have saved up, and figure out if this is going to hurt you and going to explode once you get to retirement and need those funds, or if you're sitting in a good place. So a lot of the times when people get to retirement and we start having these discussions, the most appropriate thing that people need to do is what's called our retirement V for victory. What we look at here is that when people turn 62, they are eligible to draw from Social Security. They can take it anywhere from age 62 to age 70. And there is your full retirement age, which is typically around 66 in some months or 67. And if you take it before your full retirement age, you're losing a benefit that you never get to gain back. If you wait till after your full retirement age, up to age 70, you gain an 8% benefit each year that you wait. That is such a huge benefit that we want to take advantage of. So because of this, when people get to retirement, instead of having them turn on their Social Security and start drawing and lose that benefit that they could gain, we have them pull from their investments that they've worked so hard to save. This is so uncomfortable for families because they've spent their whole life saving. They haven't got to a point where they need to start distribution, and it's not natural. It's not a normal feeling. So we have to explain to them how important it is to start drawing from the funds that they've saved in order to allow that Social Security continue growing. So what we see is the way that this retirement V for victory works is we're pulling from the funds that they've saved. So they have this higher amount in their portfolio and we start drawing that down. They're going to see their balance in their accounts go down because they're starting to live off of that money until they get to an appropriate age to start turning on Social Security. That's when they start receiving the Social Security money each month. They can pull less from their portfolio, and that allows that portfolio to start growing up again, creating that V.
100%. And well said, Jamie. And here are a couple key elements from this discussion that I really want those of us that are listening to the show to understand. Jamie said it very well. It's uncomfortable, right? I mean, a lot of families, when we meet them for the first time and they've been saving their whole lives and they bring in these giant statements, they look at them and they go, it's reached a magical number. Whatever that is, 500,000, a million, 2 million, 3 million, whatever it is for you, you go, that's my number. And honestly, we've had people tell us that if that statement was a person, they bring it to Thanksgiving dinner. It becomes something. It materializes into something that is very critically important to you as an individual. And it's hard when you hear someone tell you it's time to spend that money down now. But I don't want you to miss what Jamie said. This is a tax maneuver, right? Because especially in this environment we're in today, if you're looking at retiring in the near future or you're in retirement, this could be a very critical strategy that may help you leverage away some of that tax-deferred money while the tax code's in your favor. Because here's what's going to happen. At 72, the IRS is going to turn on their switch, their RMD switch, required minimum distribution, and say, hey, that money's now ours, and we're going to require you to take out a little bit every year. And by the way, as the portfolio grows and as you age, we're going to take out more and more. And so this is a strategy to start giving some of those dollars away to the IRS at a discount, all while letting the magical compounding growth of Social Security, that 8%, continue to grow in your favor going forward. And again, it's not for every family, but when the situation fits right and it makes sense, it's a very powerful strategy that you can employ. So if you've already taken Social Security, this may be something that may be out of reach for you. However, still understanding the situation you're in and what your portfolio looks like, we still can leverage other techniques and tools to ensure you get to the position you want to be in. But that retirement V for victory is huge. And it's so uncomfortable, Jamie.
It's so uncomfortable.
For people to do this, because oftentimes they say, Grant, why wouldn't I just take Social Security at 62? Mm-hmm. Like, the system's broke. Like, we got to take the money out now. But what people forget is, that's an old mentality, because people, when we had a lot of line workers, union workers, et cetera, those big pensions would pay out. And they would pay out, essentially you would retire before 60. And once you got to 62, the amount of pension you were getting would decrease because the pension system knew you were getting a Social Security. So it was an incentive to have people to take Social Security early. And we've just never changed the mindset. And now we blame, it's broke, they don't have enough money for it. Well, let me tell you what, folks. In the age we live in today, the Fed will print money, right? They will print money. Now, the system will be very drastically different for myself and for Jamie in the future, right? But for those of you that are getting close to taking it, as long as the system's still intact and as long as the tax code where it's today, the strategy could be very important for you and your family. And the other question we get too, Jamie, is, it's uncomfortable to sometimes address some of these situations, but from a tax perspective, And from an income perspective, they're very powerful for our families. We can illustrate that in our systems. But, we also get the question, how much can I take? So, Jamie, I've got this money now. I'm 67 years old. You're telling me not to take Social Security, but really how much money can I pull out and not really run out of money? And so what is that for some of those families?
For most of the families that we talk to, we're able to comfortably say that they can pull out anywhere from 3.6 to 4% and be able to live off that money and not touch the basis that's in their accounts. So they don't really have to worry about running out of money. One of the big discussions that we have to have is that when people first get to retirement, they are pulling out more money than they typically thought they would. So think of that retirement V for victory. They have these living expenses that they have to fund, and they're solely coming out of the investments that they saved. And so they come in and they'll say, Grant, I can't pull that much money out of my investments and not run out of money. Like, what are we doing here? So we have to really pull that conversation back and say, yeah, we're pulling out quite a bit of money in these first years because, one, we're not drawing for Social Security, and two, you have those higher social expenses when you first get to retirement. You're meeting friends out for dinner, you're going on vacations, you're taking that trip to Europe that you've always wanted to take. Those social expenses when you first retire are so much higher than what they're typically going to be at, say, 75, 80, when you're later into retirement and you're not doing all those bucket list things that you were trying to accomplish when you first retired. So we understand that those first 5-10 years of retirement, you're going to be pulling more out of your investments because you're going to be doing more. And we plan for that.
100%. Great point, Jamie. And if you're needing to analyze your situation and understand kind of where you're at in the distribution circle and how some of these strategies may apply to you, please reach out to us. 800-928-4001. Brittany will be on the other line of the phone helping you get set up with the appropriate advisor based on your current situation, your location. And also you can reach out to us at yourlifeafterwork.com and schedule a next steps meeting today. So if, again, like we talked about before, if you're doing this on your own, that's your business. We hope we give you enough educational information to do it correctly. But if you're looking for a fiduciary to take the worry off your plate, that's our business. We look forward to having that conversation with you down the road. So more resources for you that are out there on the website. You can go there and find Retirement V for Victory that Joe did. There's lots of articles and other content created, so go find that on our website. And we'll look forward to seeing you in the next one.